In the previous lessons, we've gone through the analysis of the income statement of a retail business with all of its components. However, a P&L or income statement doesn't show the full picture of the business. It only gives a view over profitability and the underlying causes behind good or poor performance on this aspect. Other key financial ratios can be calculated from the income statement together with other financial statements, namely the balance sheet and cash flow statement, to show the bigger picture on profitability, efficiency, liquidity, and leverage. But before we get into those ratios, let's first look at the other two financial statements, the balance sheet and the cash flow statement, and get familiar with their components. The balance sheet lists the assets of the business versus its liabilities and shareholders' equity. Both sides have to balance, and that's why it's called the balance sheet. In other words, assets equals liabilities plus equity. Or if we inverse the equation, equity equals assets minus liabilities. So the assets that the business owns minus the liabilities that the business owes equals the shareholders' equity in that business. Assets are segregated into current assets and long-term assets. Current assets include cash, short-term investments, and inventory. The reason inventory is considered a current asset is because typically merchandise can be liquidated quickly if offered at lower prices. Current assets also include accounts receivable, which is any payment that's due to the business for goods delivered to customers but still not paid for. Since we are talking about retail and e-commerce businesses, and these businesses typically get paid before the customer receives the goods, we didn't include this in the template. However, if you are selling on installments and will only get paid later, this is where you will insert this amount. Long-term assets include property and equipment. Liabilities are also segregated into current and long-term liabilities. Current liabilities include accounts payable, for example, payments due to suppliers, and taxes that are already due. Long-term liabilities include any long-term debt. Finally, equity will include any share capital that the owners paid in the business and any retained earnings that the business has accumulated over the years and didn't pay them out in the form of dividends. And as we said, the total liabilities plus equity should always equal assets. The cash flow statement shows the movement of cash in and out of the business during the particular period measured and under which category of activity this movement is categorized. This could be for operating activities, investing activities, or financing activities. For example, when the business receives cash from sales and pays out cash to suppliers and landlords, this is all under operating activities. If the business invests in buying new equipment or receives interest, this is under investing activities. When it receives cash from a bank loan or pays back an old loan, this is financing activities. At the end, all this cash from different activities is added to or subtracted from cash at the beginning of the period, and the result is the cash balance at the end of the period. Now we are going to use the information on the different financial statements to calculate different financial ratios that give indications on the business profitability, liquidity, efficiency, and leverage. We will start by highlighting the key financial ratios for retail companies and then go through the other metrics under each category. At the end of the income statement comes the most important number, and that's the net profit figure and its percentage to sales. For example here, the net profit margin of the business in 2014 was 6%. This means that every $100 in sales generates $6 in net profit. Like other lines, we look at this figure in comparison to the historical figures of the business as well as the industry's benchmark in general to be able to assess it. Since this is the final result of the entire operation of the business, any improvement in any of the lines of the income statement will directly reflect on this figure. In fact, small changes in some important lines such as sales and gross margin could have a huge impact on the net profit. As we explained in the pricing course through an example, where a 1% increase in sales due to raising prices by 1% has led to 15% increase in net profits. Sales and gross margins in particular have a very high impact on the bottom line of the business, where even a slight improvement could reflect highly on the net profit figure. Other ratios that are specific to retail businesses are GMROI and inventory turnover. Those two ratios show how efficiently the company is managing its inventory and getting returns on the investment in it. Every time the business goes out to buy a new collection of merchandise, it's actually making an investment that generates a specific return. GMROI measures how much the company makes on every dollar invested in inventory. And inventory turnover measures how fast the company is able to turn such inventory during the year and invest that amount again in new stock that generates more returns for the business. As we explained before when we talked about business models, a value retailer could still generate high net profits in absolute value despite having lower gross margins, only if it's able to turn its inventory fast enough to be able to make profits on every turn, and so the total amount will still be high. Same applies to retail categories that operate at lower gross margins, such as grocery stores, convenience stores, and pharmacies. So while assessing the performance of a retail business, we don't look at sales and gross margins in isolation, but instead combine them with those two metrics to get the full picture in light of the business model of that particular retailer. Then we can compare them to benchmarks from similar retailers operating at the same business model within the industry. Now let's review the different financial ratios, their formulas, and what they indicate. Profitability ratios include net profit margin. This indicates how much the company generates in profit for every dollar of sales. Gross profit margin. This calculates the margin available to pay expenses beyond the cost of goods sold. Gross margin return on inventory investment. This measures the return on every $1 invested in inventory. Return on assets. This is a measure for management efficiency as it calculates the return on all the assets under its control, regardless of the source of financing. Return on equity. It measures the return on the shareholders' total investment in the company. This is particularly important for business owners and investors. Efficiency ratios measure how well a company is utilizing its resources. In retail, that's mainly inventory. Efficiency ratios include inventory turnover and days sales in inventory. They both measure the same thing, which is how fast the company is able to turn its inventory. Liquidity ratios measure how well a company is able to repay its short and long-term debt obligations. Liquidity ratios include current ratio, and this measures how much of current assets are available to cover each dollar of current debt liabilities. Current debt liabilities are short-term debt obligations that should be paid within 1 year. Current assets include cash and assets that can easily be converted to cash, such as marketable securities, account receivables, and inventory. A figure that's greater than 1 means the company can cover all of its current liabilities from its current assets. But if this figure gets too high, it might indicate that the company has a lot of cash that could be utilized in a better way or invested back into the company to drive growth. When we exclude inventory from this formula, we get the quick ratio, also known as asset test ratio. In this case, the remaining current assets include cash, marketable securities, and account receivables, which are all considered quick assets because they can be converted to cash quickly. Just like the current ratio, a figure that's greater than 1 implies financial well-being of the company, but too high of a figure indicates too much cash left unutilized. If we only include cash and cash equivalents in the formula, we get the cash ratio. Cash equivalents are assets that can be converted quickly into cash with minimal risk, such as savings accounts, treasury bills, and money market instruments. This is considered to be a more strict ratio for measuring liquidity, as it only looks at cash and its equivalents. Operating cash flow ratio. Unlike the other liquidity metrics that depend on assets, this ratio depends on the cash flow from operations, which is cash generated from the core business of the company. Not only does this measure how well a company can cover its current liabilities from cash from operations, but it also indicates how much the business is generating in cash from every dollar of current liabilities. So unlike the other liquidity measures, where a high figure indicates poor utilization of cash, this measure, if high, does not imply poor performance, but on the contrary, it indicates that the business is efficient in generating cash flow from its current liabilities. Leverage ratios show how the company's assets and its business operations are financed. Leverage ratios include debt-to-asset ratio or debt ratio. This measures the percentage of assets that are being financed with debt. This ratio is used by analysts, creditors, and investors to measure the degree of risk of this company. The higher the figure, the riskier it is to extend loans to and invest in. Debt-to-equity ratio measures the funds provided by creditors versus the funds provided by the company owners or shareholders. It indicates whether the business capital structure is more built on debt or equity financing. Business owners, creditors, and investors all use the different financial ratios to assess the performance of the company by comparing those ratios to industry's benchmarks. So as we could see throughout this course, analyzing a retail business performance starts from the end, from the financial statements, and then goes deeper into the possible underlying causes of such performance by analyzing more reports and metrics for different functions within the business, and try to improve financial performance by optimizing each of those functions to deliver their part of the final result for the entire company. In other words, good financial performance for any retail business is driven by good performance in sales, buying, merchandising, marketing, strategy, and all the different functions within that business. Such thorough analysis is then taken and used to form future short and long-term plans and strategies to direct the future performance of the business. This brings us to the end of this course on retail business performance analysis. Thank you very much and see you next time.